Today we're going to be talking about the difference between superannuation accumulation and superannuation pension phase. So superannuation is made up of two phases, accumulation and pension phase. Accumulation phase is where contributions are made to. So for example, employer contributions, salary sacrifice contributions, personal concessional contributions, which are like self-employed tax deductible contributions, or even non-concessional contributions, which are contributions made to super with after-tax dollars. So once contributions are made into a superannuation accumulation account, assume you've got a balance in there, that balance is invested, and it can be invested in whatever you like within the constraints of the investment options within your superannuation account. So usually with like an industry fund or retail superannuation fund, you might be limited to say bank accounts, term deposits, managed funds, shares, or multi-manager investment options. Like you might have heard of the terms balanced or growth options or all of that. So they're just a type of managed investment. All of these investments, if you have a self-managed superannuation fund, you might have direct property in there, so or business property which receives rent. So the property can receive rent, shares receive dividends, managed funds pay distributions, bank accounts and term deposits pay bank interest. And some of these investments might also have capital gains. The tax on all of those investments is capped at a maximum of 15% within accumulation phase. So all of those earnings taxed at a maximum of 15%. Capital gains tax can effectively be reduced to 10% if the asset sold was owned for longer than 12 months. So this is one of the benefits of investing in superannuation as opposed to say your personal name, where you might pay tax at a higher tax rate based on your individual tax rate. So your accumulation account, you can keep as much in accumulation account, you can keep accumulation account open for as long as you like. You don't have to convert it to a pension account. You can keep it there. And if you've met a superannuation condition of release, you can make lump sum withdrawals from your accumulation account. Or you can use some or all of your accumulation money to commence a pension, provided you've met your superannuation condition of release. So that money can then be transferred into pension phase, and pension accounts require you to draw a minimum income of between 4% and 9%, depending on your age. It changes as you get older, it increases. That's the minimum pension income factor. And that percentage is multiplied by your balance to determine how much you must draw out as income each year. If you have an ordinary account-based pension, which is the most common type of pension, and this is when you're generally fully retired, you're not working any longer, there's no maximum threshold on how much income that you can withdraw. If you have a transition to retirement pension, which is generally a pension that you start if you've met your superannuation preservation age, but you're continuing to work. A TTR pension, as they're called, transition to retirement pension, has a maximum of 10% income that you can withdraw each year. So that's the difference between an ordinary account-based pension and a transition to retirement pension. You cannot make contributions to a pension account. Contributions can only be made to a superannuation accumulation account. The tax rate within a pension account, for an account-based pension, all earnings and all capital gains are received completely tax-free, which is one of the benefits of having money in pension phase, specifically an account-based pension. However, you must draw that minimum income down each year, whereas within an accumulation account, you don't need to draw down any income. You can make lump sums from the accumulation account, lump sum withdrawals, but you don't have to each year. A transition to retirement pension, on the other hand, is taxed. The earnings are taxed identically to an accumulation account, with all earnings taxed at a maximum of 15%. At any stage, you can roll back or transfer some or all of your pension account balance back into accumulation account and back into pension account as often as you like to meet your needs. So just provided you've met that superannuation condition of release, which allows you to convert it from accumulation to pension phase, it can then be rolled back to accumulation phase if you wish. So just to recap, accumulation phase, the difference between pension phase and accumulation phase can receive contributions. A pension phase, you must draw a minimum income each year based on your account balance and your age. Tax on earnings within accumulation phase is 15%, whereas in pension phase it can be 0% under an account-based pension. And you cannot contribute to a pension account. You are only allowed to contribute to an accumulation account. So that's the main differences between accumulation phase and pension phase. There are some other differences, but these are the most common major differences with each phase. Thanks for listening. Please subscribe to the channel if you'd like to see more videos to help you maximize your super. Thanks for listening.